Real estate. Let's talk about it. Should you buy real estate in 2025?
The homes have been going up in price.
All the doom and gloom of real estate you hear on the news right now. Do you buy a single family home right now, and is the market going to collapse? Real estate. Let's talk about it.
I got a big announcement at the end of this. I'm going to share with you what I'm doing personally.
Let's talk about mortgage rates. Let's talk about the market. Depending on where you live here in Oklahoma, it's getting kind of rocky.
It's gotten kind of crazy since COVID.
Let's talk about if you're in commercial and the tenants moving into these markets. You know, just because you got a tenant doesn't mean they're going to keep on paying, right? Let's talk about all the doom and gloom of real estate you hear on the news right now. And we can finish it up and leave with a positive note and talk about the things that if you are an investor, this is when you get rich, potentially.
And I think a fair note is that him and I have quite the real estate portfolio, so we know what we're talking about. And him personally, you have quite the real estate, not just with you and I, but just your own. So we're not your typical people on here talking about this. We're living it. So might want to listen. What are you eating? Looks good.
These things right here, these Reese's, man, they're the best.
They're my favorite candy.
And you know what they just came out with?
What's that?
The best Reese's ever, the Reese's egg. For the Easter eggs.
The Easter eggs.
Oh my gosh.
They're all the same.
I just ate 9 of them.
They're all the same.
No, they're not.
All right, well, tell people what they want to hear.
Well, let me give you a little background what real estate I'm in. If you guys watch our videos, you know that Eric and I are passionate about real estate. You know that Eric and I own real estate together. I own real estate by myself. I own it with multiple other partners. I own it with my brother. So let's talk about the different types of real estate I'm in personally, some of which you are my partner on, and why I think my opinion matters. And I'll give you some background. I'm in multifamilies. We own multiple multifamilies in multiple different cities and markets, from inner city to rural development. Let's talk about commercial construction. Eric and I are participating in a large retail center in a metroplex area here. Let's talk about urgent cares and health care, right? Eric and I own an urgent care, multiple of them. Let's talk about single family residential and single family development. I own both of those. I got a development going on with, I think, like 130 homes left to build. And then we also own single family rentals. And I think you're building a new home too. Oh, okay. Sneak peek. So then let's talk about just industrial land in general, you know, industrial buildings / industrial just gravel lay down lots. And then we also have a pretty nice sized portfolio of self-storage facilities. So saying that, what's neat about participating and building these and owning these and managing them from everything from the ground up, because we have our own internal property management too, you get to see the true numbers and how these things perform and do they make money and what the headaches are to run these things and own them, because they do have headaches involved in this. You hear all the time about all these people, how great multifamily is and how great industrial properties and how great industrial multi-tenant properties are. They all can be great if ran properly, if financed the correct way, and if you had the right tenant. That's the most important thing. So I'm going to give you my perspective based off my experience and my experience only, and based off the groups I hang out with that own a lot of real estate too. So let's talk about
where the home prices are at right now.
Let's talk about single family homes.
Yeah,
that's
what most people are
most people own. Do you buy a single family home right now, and is the market going to collapse? How many times you hear, I'm waiting on that 2008 market collapse to get back in. I'm waiting on that 2008 market collapse to get back in. Interest rates are too high. Home values are too expensive. How many times do you hear that on a YouTube channel or for a friend or a family or whomever?
I'll tell you this is I've been very fortunate on the last house that I bought, and I bought it on the low, and I did that purposefully. So sometimes, you know, when you buy a house, I was pretty young. I think my first one I was 25, somewhere in there, and had a strict goal to buy something that was way below the market, what the comp rates were, right? So that was that point in my life, right? Of, you can look at home buying in a couple different ways. You can you've got enough money and you can get what you want, right? Or you can get what you can afford.
What you qualify for?
What you qualify for. Or you can be somewhere in between where you can be choosy and you can say, hey, I've got an agenda on what I want to do with this. I'm not super picky. I just want to make money off of this thing. And that was the route that I took. But right now, in this area here, the homes have been going up in price.
Well, Oklahoma in general, in the Midwest or the Mid-South, homes are generally cheap.
Comparatively. So that's a good point to talk about. But I will say right here in the Midwest where we're at, from, let's just say when I bought my first home, I can't remember what year it was, but it was about 10 or 12 years ago, to right now, the value went up at least 50%.
Well, since COVID, everybody's experienced significant increase in equity. And equity is what the value increase in the difference between what you owe. If you owe 100, it's worth 200. You have $100,000 in equity, right? That's equity. So COVID really inflated a lot of prices very, very quickly.
Yeah.
Especially in places like Florida. I remember when I lived in Florida, I was looking at condos for like $750,000, $500,000, somewhere in that price range, and now those are $1.5 million.
Yeah.
The thing to consider is I look at things a little bit differently because I'm a little bit more seasoned and I've made a lot of mistakes and I've learned from my mistakes, right? I do the exact opposite what the masses are doing. So do I think homes could come down another 3 to 5%? Yes, I do. But when interest rates are high and there's less buyers in the buyer pool market, I think this is the time that you might be able to negotiate a price down 15, 20% or 7%. So yeah, the negotiating rate might be greater than, right, than your interest rate. Your interest rate's a variable cost, right? When rates come back down, you refinance that house.
I'm ready for that.
Yeah, so right now you buy a house and I just looked it up, the average mortgage rate is 6.7% right now.
Yeah.
And a lot of baby boomers are retiring and they have their house paid off. That was their kind of like their legacy. Like, I want to have a house paid off.
Yeah, and that's a lot of people's goals, and there's nothing wrong with that.
They're not defaulting.
And I will say what's interesting to think about for everybody out there is, our high interest rate right now is nothing compared to what it used to be.
I mean, it is when you see all your buddies that buy that $700,000, $500,000, $400,000 house, or you're getting into a starter home, right? And 2 years ago, you qualified for a $600,000 house, and prices were lower, and now you're qualifying for a $400,000 house.
Yeah, that's basically the interest rates, right? Go up, it makes your monthly payment go up, and then what does the banks look at?
They look at your cash flow, your debt to income ratio. Yep. And if you're a W-2 employee, and it's a lot harder to get a loan if you're self-employed and you've only been self-employed.
Way down that rabbit hole.
Yeah, I'm doing it right now.
Yeah, it's a BITCH.
But
to be a fact.
We're in a time of uncertainty and a lot of changes going on in our economy. We have multiple podcasts coming out, just touching a few of these subjects. But you're building a home right now, and we're getting ready to get in a tariff war. We already are with Canada. They supply a lot of our lumber. We just got a parts increase on our parts. But long story short, is right now the time to buy a single family home? I would say yes if you can negotiate it correctly and you qualify for the loan you want. When rates come down, yeah, you're going to be able to qualify for a lot more of a home loan, but you're going to have a lot more people in the market. The prices are going to be less negotiable, and I think the prices will increase.
Yeah, for me, in my opinion, I think the single family home, and break it down into a section here, because in my opinion, when the interest rates are high, then people can afford less of a payment, right? So when you think about it that way, that means there's going to be more demand for your single family, smaller square footage homes, which more demand is going to create higher pricing, right? So if you're looking to get a, 1,100 to 2,000 square foot home, you're probably going to pay a little higher premium on that right now than somebody that's lost their job and they can't afford their 4,000 square foot home anymore.
Well,
you know what I'm saying?
Another thing to consider is a lot of people forget this, right? They look at what they qualify for. One thing to consider is it doesn't matter if you own a single family home or a multifamily or industrial. It doesn't matter what the asset class is. The thing that you need to consider is what does it cost you to own and operate that home, right? Yeah. If you have a pool and you have insurance and you have HOA and you have lawn care and you have all this stuff that you want to have in this home and maintenance, it costs you a percentage of your home just to own it. And a lot of people forget about that. Florida's a prime example. All these baby boomers moved down to Florida because the weather's perfect, and they moved down these condos and they're on these fixed incomes, and it's sad because insurance went up 30%, 40%. HOAs are getting hammered with insurance, so they're charging more in HOAs and all these assessment fees in condos. And then their valuations went up over the last 3 years, so guess what's happening to their property tax? It's reassessing their property values and now their property tax. So now this fixed income that they had to live off this home, and now it just went up by 20, 30% or 15%. Scary. They can't afford it.
Yep.
There's more homes right now for sale in Florida than it's crazy.
Yeah, and it's probably going to be a disaster at some point if they don't bring them down.
Well, people that have their homes are paid off, they're having to make a choice if they want to insure it or not.
Yeah.
A lot of that's their life savings. So be cognizant of what you're doing. Look at your finances. Don't overspend. Especially in a single family home, it's something we all cherish, and it's an American dream to own a single family home, but there's a lot that goes into it. And is right now the time to buy a single family home? I would say yes, if the price is right and you can negotiate. So let's move on to industrial. I love industrial properties. That's one of my passions I have developed over the years. One reason, because it's super simplified. You go build an industrial property, a red iron building as we call it up, or a metal or a concrete tilt up, and you can get triple net creditworthy or triple net tenants, meaning they pay for your taxes, insurance, and all your maintenance. They reimburse you for those things. So it makes it super simple. They inspect the property before they move in. They assume the risk and the conditions as it is, and then you charge them for everything else. So you get one check every month. You don't have to send them an invoice. They have typical late fees, and it's just a super simplified, scalable asset. The kicker is banks usually want a little bit more down on those assets. When a tenant moves out, if it's a single tenant industrial building, you're 100% unoccupied. And depending on the size of that building, it can be a very large payment. Or what we've experienced is we had a tenant not being able to make its payment. It was a smaller company, leasing out a smaller facility, and we had to work with them. They weren't able to make the monthly payment on that building, but they have rules and rights too. So we still had to make that payment to the bank.
Yeah.
So industrial properties are awesome. It's my favorite thing.
Yeah, and I'll say this about industrial properties. We do love those both. And, the other thing that he didn't mention is that from my experience and probably from his, the occupancy rate of those things tend to be pretty high. And whenever you do lose a tenant, God forbid that happen, but that is reality, is when you do, there tends to be somebody right behind them that's looking to take that property and lease it from you.
So we specialize in, to clarify what Eric's referring to, we specialize in small industrial buildings. So anything 12,000 square feet or less. We have some a little bit bigger, but mainly 12,000 or less because we don't want to deal with sprinkler systems. And there's a lot less permitting in Oklahoma. Yeah, but the problem with a smaller warehouse is you're dealing with a smaller type of tenant, meaning a less seasoned tenant. So they don't think far in advance. It's kind of like owning a multifamily. We'll touch that too. They're thinking 3, 4, 5 months in advance. So it's hard to get a build to suit. So you almost have to do a speculative type building, hoping that the market stays strong while you're doing the construction phase, and then backfilling it with a tenant. In our case, we already have the buildings. A tenant moves out. We start marketing it if we know that they don't want to re-up their lease 3 or 4 months in advance, and we always usually are able to backfill it because in Oklahoma, it's a growing state. We have a lot of influx of people and new businesses. And so I think industrial properties in Oklahoma are great. I don't know if I'd want to be in industrial properties in California or some of these other places. You just hear this mass exodus. I don't know if I'd want to own that, but...
No, but I think California's doing that themselves, with all the taxation.
Yeah, and the complexities of new construction and permitting. And
we learned a lot when we went to San Francisco there. You remember the conversation that we had in the car about them having to build basically in these apartment buildings, anything that was housing
Oh,
people,
a percentage of it for
percentage
homeless.
of it for homeless.
Crazy.
And I don't want to go down the wormhole on that. I think we should take care of our homeless. Don't get me wrong. But when you have to do that, when you're building the facility, they have to make up that 10% that they're giving to the homeless somewhere. That place is going to be in the people who are renting from the other places that are bringing in the income.
100%.
So it's a silly thought. I don't know how or who ever went down that rabbit hole, but that is complete ridiculousness. So, but we don't want to get into that. So
let's talk about multifamily.
Yeah, you have a lot of experience.
I have a lot of multifamily. I built multifamily. I bought multifamily. I rehab multifamily. I currently own and operate a lot of multifamily.
Yeah.
Just got done signing checks in the next room for all different types of things with multifamily. Multifamily is a great asset class. I like it. It's going to be around forever. Humans have to have a place to live, and a lot of the younger generation, they don't have the capital to take on those variable costs as if you're a homeowner. So they go in there and they live in these apartments that have these fancy pools and or that's just affordable housing. We have nice affordable housing. Our rent for us is $1,200 to $1,650 a month. And you get a garage and it's nice, granite countertops, and they're new and they're full brick, and they're usually duplexes, quadplexes, sevenplexes, some multi-story, etc. That's our space. You hear Grant Cardone and many other individuals that do these 500 unit, 1,000 unit, large apartment buildings. I think you can make a lot of money doing that. There's people that are very successful. That's not my niche.
Well, let's talk about a couple of things. So I think it'd be prudent, and I think everybody wants to know this, is what do you think is sexy about multifamily?
Well, like for us, we develop a whole street and we'll have 30 or 40 in the location, right? So when one tenant moves out, you're not 100% vacant, right?
Makes a lot of sense.
And then as you construct them, you're staggering your leases. So 12 months, usually put them on 12 to 24 month leases. So not everybody's moving out at the same time either, if they all fulfill their leases. Another nice thing is, since they are on 1 year lease agreements versus like industrial property or commercial property where you have to factor in your increase of rate, your 3 to 5% annual increase, you don't have to really do that with the multifamily, because as you sign that new lease on a 12-month agreement, you factor in the increased rate right there in the contract.
Okay.
So, and we usually, I'm not saying we don't sign longer term leases in 12 months, but we usually like the 12-month contract to see if it's a good partnership. And usually if they like to be there, they'll re-up it anyway.
Makes
so
sense.
the negative thing to
that's where I was getting ready to go.
Negative thing, there's a lot of moving pieces, and they have a lot more rights than somebody would in an industrial commercial setting.
Yeah, because I think everybody here...
It's a lot more emotional when they get kicked out of their house and don't pay their bills. It's a lot more emotional when the air conditioner doesn't work and they're sitting there on a Saturday and it's 110 degrees and it's your responsibility to fix it. That's why they live there.
It's a lot of pressure.
And you got dishwashers, you got toilets, you got HVAC, you got air filters, you got garage door openers. There's a lot more moving pieces in those. You got lawn care, landscape, and sprinkler systems in our units that you have to maintain. So there's a lot more moving pieces. It takes a different type of management, takes different types of systems. We use Yardi as our operating software to manage all asset classes, from multifamily, industrial, commercial, residential, and everything besides self-storage. We use ESS, Easy Self-Storage Solutions, on self-storage. So I would say multifamily is great, but you better be ready to handle lots of movement. It's a great way to add on lots of doors very quickly and create a cash flow spread per door on scale very quickly versus going out buying 200 single family homes. That's 200 mortgages. You could go buy one 200 door apartment complex, one mortgage, one insurance payments, versus 200 mortgages, 200 insurance payments, 200 property taxes, one property tax.
So it sounds to me like it's just way easily, I could say a little bit more easily managed.
It is easier to manage, but a lot of them trade off net operating income. Let's talk about that. Net operating income, it's the cost of owning the property minus all your expenses and what's left over. So let's go into that real quick. This is what I think. Let's talk about financing, because this is what I'm skipping around here a little bit. financing in all markets, from residential to commercial to industrial, is playing a humongous part of these real estate sectors right now. It's scary.
Why is that?
Because 20% of all mortgages are coming due in 2025, commercial mortgages, which is like 900 and something billion. I just looked it up. There's $4.8 trillion in real estate, in commercial real estate in the U.S. Trillion. 20% of that's coming due this year. Why is that a big deal? Well, when 2 or 3, usually commercial real estate's finance on 10, 15, 20, 25 year amortizations. So an amortization is how long you spread out your payments.
Yep.
Most of the time, it's not fixed for the same amount of time. So if you have a 20-year amortization, you're not fixing that rate for 20 years like a traditional mortgage you would do at your new home. Mm-hmm. You put on a 30-year mortgage, your rate stays at whatever you lock it in unless you refinance it. Commercial real estate's a little bit different. It's usually fixed for 5 to 10 years and sometimes up to 3. So why is that a big deal? Well, let's say that you bought an industrial building. And let's say that you have that rate at 4.5% like you and I do. And you bought that industrial building 4 years ago, and here it is, 2025. This is the 5th year, meaning that you only locked in that rate for 5 years. So you're about to take that industrial building, and that rate is going to change. It's going to increase in this case. Sometimes it decreases, and sometimes it stays the same. In this case, it's going to go from 4.5 to 6 to 7 to 8, depending on how comfortable the bank feels.
Yep.
And what does that do? It's going to change your bottom line, your net operating income. And sometimes, and a lot of times in this case, during COVID, people were overspending. They were overspending. Property values went up, locking in cheap rates. They were overspending on these properties, and now the margins were very slim because they were like, oh, the property's going to continue to go up in value. Well, they're not going up in value right now, and your rate's about to be reassessed, and they're going to go in negative cash flow.
Ouch.
And
then what do banks look at?
Net operating income, your debt service income ratio.
There you go.
And you're not going to meet that. So that is called...
That's scary.
I've done that before.
Yeah, if you're not meeting your debt service ratio, then the banks can basically call your note.
It's called technical default.
Ouch.
If
Sounds
you don't,
terrible. It is terrible.
Yeah, so like in our case, let's give you a prime example. We have an multifamily property. We did a pressure test and to see if the property would still cash flow during construction phase and lease-up phase, and then per financing at 5.5%. Because at the time, rates were at like 4.5. We're like, what's the chances it's going to go up a point and a half percent? It hasn't done that last 10 years.
Yeah.
It just doesn't happen. It hasn't done that 10 years. What's the chances it's going to happen before I'm able to lock this rate in the next 24 months for construction lease-up phase? Well, hell, it went up to 7.
Yeah, you're like...
So guess what happens to all your income?
It goes bye-bye.
It goes bye-bye. You have no income. You're paying somebody to own the property.
Yeah.
So how does that feel? I'm going to tell you something. It does not feel very good. You're already getting beat down. You're already having to pay out of your pocket to fix anything that's going wrong with the property because there's no income left. You're paying principal and interest and insurance and taxes, right? And then you get this nice little letter from the bank that says, hey, by the way, we're sending you a notice of technical default. And I didn't even know what that was. And a technical default means that your property, even though you're still making the payment, we were still gap filling our payments and still to this day are. We were not meeting debt service income ratio. So we were in technical default.
But still making all your payments on time.
Yeah, so being a redneck from a small town, I'm like, you make the payment, everybody's good, everybody's happy. No, because banks borrow money from the feds, and they have to meet certain ratios and certain guidelines and certain regulations, right? And we were making the payment, thinks everything is good. We didn't meet DCSR, and guess what happens? We get this letter in the mail. I was like, there's no way. I called my banker. He's like, hey, we need to have a meeting. And I call him, and I said, hey, what's going on here? I'm making the payment. You already know it's tough. Like, hey, we got to send this letter out. Luckily for us, we were able to work with them. But there's a lot of people, they're not going to be able to gap fill.
That's the issue, is they're not going to be able to gap fill. And that's why real estate can get a little hairy.
I'll give you an example. This one I'm gap filling $18,000 a month.
Yeah.
One property, $18,000 a month. I've been doing it for like 5 months, 6 months. One property.
That sucks.
So be careful what you sign yourself up to. Not everything is going to be profitable. Don't be crazy optimistic. Run your numbers. I don't think rates are going to go to the roof right now, right? I don't think they're going to go like from 4.5 to 7.78% like they did with me. So the chances of that and the risk tolerance could be a little bit better if you can get a good deal on property. But I also think it's a lot harder to make properties cash flow at 7% rates. 8% rates, the values are going to have to come down. You're going to have to finance less dollars, and or the bank is going to require you to put more money down.
Nobody likes that.
So instead of being 75% debt service, that means you're going to put 25% down. So if you buy $1 million property, the bank's going to say, hey, we'll finance $750,000, but I want $250,000 down. Or they want 30% down. That's $300,000, or 40% is $400,000. There might be another widget that you can invest in at this time that's going to give you a better rate of return on your cash. Because that cash is important.
So I think myself and everybody else wants to know is right now a good time to invest in real estate, or is it not?
I think it's like anything else we do in how we run our service companies and how we run our life in general. I think when some people are losing, some people are winning. And I think when some people are winning, there's always going to be some losers. I think it all is depending on what type of deal it is. I'll give you an example. We are thinking about building truck parking.
Oh, I love that one too.
So that's a gravel yard. There's no vertical movement. We're not building a building on it. We're literally taking a piece of land off of an interstate. We're plowing it over, excavating it, putting no utilities on it, hardly, putting some fencing around it, graveling a yard, and leasing it out to truck drivers to park their trucks at night.
Yeah, I think our new strategy as we're getting older and wiser, our new strategy is less people, less movement, and still get cash flow.
Yeah, like that one, I'm like thinking about it, like we can construct it within 4 to 6 months.
Yeah.
Right? There's no insurance hardly on it because we're not insuring buildings, right? To repair it, it's gravel yards, and you get daily, monthly, and weekly rental. And there's already softwares to manage this type of asset class. So it's something we're going to test out. We already own multiple gravel yards together, Eric and I do, and I own a few with my brother, and they're all leased up, and they all make really good money. Yeah. And you don't get tax increases, very little. So that's one that we're going to go ahead and push forward on the development. But is right now a good time to buy or not? I would say depending on the asset class and depending on what you can get what kind of deal you can get on it. I would say if you can get a really good deal and it still cash flows at 7-8% rate, pressure test it a little bit more, you're going to cash flow when you refinance it.
I agree.
You can create a spread and create a lot of value really quickly. So I know guys right now, you look at this number right here, $4.8 trillion. I think they're going to say, here you go, bank.
Have it back.
Have it back. I don't want it. It's not making any money.
Yeah.
And here you go.
What do you think will happen if that happens on a mass scale?
It's going to get weird. I think a lot of these people.
It's going to get weird.
I think a lot of people a lot of these companies that had these grand scheme ideas and they overpaid for them. And I think they're just going to hand them back. I think you're going to have a lot of apartment complexes come back to the banks. I think you're going to have a lot of large industrial buildings. And it's like the perfect timing of like, oh shit. Mm-hmm. Because the economy is getting squeezed right now. Businesses might not be doing as good. So think about your rate goes up. Tenants not paying their bill.
It's a perfect storm.
Right? And then your market rate gets adjusted and you have no personal guarantee. What are you going to do? If you have a $100,000 a month bill or $200,000 a month bill in an apartment complex, yeah, and there's going to be a lot of people invested in that lose their money. So be careful who you invest your money in. Be careful what type of asset class you invest your money in, and just be careful in general right now, because right now is where seasoned investors become rich, and people that had really good marketing schemes and they could talk the talk, but they never been through these dips. I think there's going to be I think banks could be in trouble. So think about if you're a bank and you have to repo
What are they going to do with the property?
Banks are not in the
You know what I
business
mean?
of owning things. They're in
That's
the business
what's
of lending
scary.
money. So a bank is not an operator. So a bank is going to have to make some tough decisions too. So if you're a small regional bank, or you're a really small bank and you lended a couple big real estate deals, those will probably have PGs on them. But let's just say you're an institutional type bank and you took back $500 billion in real estate. So not only do you have to pay the taxes now, the bank has to pay the taxes. Not only does the bank have to pay the insurance, not only does the bank have to manage it, they have to overinflate, and they're going to have to fire sell it.
And take their own loss.
And take their own loss just to get it off their books, and the banks might not be able to withstand it.
And that's where the rich people come in.
That's where the rich people come in.
They buy that shit.
Or
for
the
$50
government's
million.
going to have to get really creative.
Yeah.
I think that's why Donald Trump, he's a real estate guy, and I think that's why he's coming in there, not just to refinance our federal debt, but I think he's coming in there saying, we have an issue.
Yeah.
And if we don't get this rate down, and the Federal Reserve is not helping him do that, he's forcing them to push the rate down. And if they don't get that rate down, I'm telling you right now, that 20%, a nice chunk of that's going to be in default.
That's going to be a bad deal.
It's not going to be a good deal. It's hopefully, if you have cash, that's when you come in there and you make a spread. That's when I said, is that a good deal or not? If you have cash and you go in there and you understand the value of the property, you can really make out like a bandit. So, hey, tell me about what your news is.
Well, it's kind of been a saga, right? Of 6 years. So just to make it short and sweet, this is a strategy that I use that I wanted to share. So if you can time it right, when the material I'm building a new house, okay, and if you can time it right, when interest rates are high, material is typically going to be low.
100%.
And you can get on that train at the perfect right time and build a house with material cost that is on the lower end that you'll ever see. And then the rates come down in between the build, right? Then you have literally created the perfect equity storm. You have low material costs, which is going to be a lower cost to build the house than what it will be when the interest rate goes lower and the material goes higher, okay? And then I'll be able to finance it because I don't have that much fucking money, right? I'm going to finance it. So I'm going to finance it at the lower end of the rate and buy the material in the house at the lower end of the rate at the same time. If you can catch it right there in the perfect time. And I'm not saying I'm at the perfect time, but it's a saga because I was going to do this before and the material rates when the interest rates just started skyrocketing, I was getting ready to sign to build my first one, and then I got cold feet, and I was like, it's not gonna be the right time. So I pulled the whole reins back.
Well, you're doing the exact opposite of what I did. I started my home, did not lock in my lumber pack, got my financing, and then OSB went from $12 a sheet to $45.
That's what I'm saying.
And then I got down on my product. The opposite. You're trying, and you might. Now, what I would be curious to see, you should ask your builder, did they lock in their lumber rate? Yeah. Because I was told that HVACs just got a 25% increase and lumber just got a 15-20% increase. So my curiosity is, your rate that you have on your contract is locked. Mm-hmm. Did they lock in their rate?
Ooh, it'd be a bad deal if they didn't, because the lumber pack is going to be an expensive hit.
Yeah, I took it was like a 23% increase on most of my lumber pack if you average it out, just on lumber alone. Mm. And then here's another thing too, is like on yours is to your point is, you're building your home, in my opinion, when home building new construction is slow, what happens to all the trades? They slow down with it.
For sure.
So you can renegotiate your rates with these trades a little bit better. It's not going to be crazy, but it's going to be 3 to 5%.
Yeah.
And if your trade cost is 25-30% of your home, that matters on a home like you're building.
Big time.
And then when rates come back down, guess what's going to happen to that home you just built at a lower rate? You're going to have immediate equity spread.
Yeah.
And that's going to be a perfect storm for you and your family.
So cross your fingers. I think I might have done it. But we never know.
It's not built yet.
It's not built yet.
But it's going to be a beautiful home. It's going to be awesome.
It's going to be great. So thanks for watching. Make sure you like. Make sure you subscribe. Make sure you share to all your other real estate friends that want to learn something or another. Thanks for watching. Till next time.
Chasing millions, baby.
Baby.